Hi everyone. In this video, I will explain some important ideas from Chapter 17, the Fed, Money and Credit. Today, I will focus on how the Federal Reserve, or the Fed, controls the money supply and influences credit conditions in the economy. What is the Fed? The Federal Reserve is the central bank of the United States. It has two main goals: to keep inflation under control and to maintain stable economic growth and employment. The Fed uses different tools to manage the economy, mainly by influencing the supply of money and credit available to business and consumers. How the Fed controls money and credit. There are three main tools that the Fed uses. First, open the market operations, and this is when the Fed buys or sells the government securities.
When the Fed buys security, it injects money into the banking system, making it easier for banks to lend. When it sells securities, it takes money out, making loans more expensive and harder to get. Second, the discount rate. This is the interest rate the Fed charges banks when they borrow money directly from it. If the Fed lowers the discount rate, banks borrow more and lend more to the public. If it raises the rate, banks borrow less and lending slows down. Third, the reserve requirements. These are rules that say how much money banks must keep in reserve and cannot lend out. If the lend lowers the reserve requirement, banks have more money to lend. If it raises the requirement, banks have less to lend. Why controlling money and credit matters? Controlling money and credit helps the Fed manage inflation and economic growth. Too much money and credit can cause high inflation. Too little can cause a recession, where businesses closes and people lose jobs. By carefully adjusting its tools, the Fed tries to keep the economy balance growing steadily but without letting prices rise too fast. So in conclusion, in summary, the Federal Reserve is crucial for keeping the U.S. economy healthy. Through open market operations, the discount rate and reserve requirements, it controls money and credit. These actions help prevent inflation, encourage employment, and promote stable economic growth. So thanks for watching.